Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Okay, just want to give you quickly what our dollar view is, and we've had this for a while now. And I tried to put this, I think I presented this about 3 or 4 months ago, the first time I presented this, and I tried to encapsulate why it makes sense in the world for the major players to want the U.S. dollar to appreciate. And this was very much part of our dollar call. We've been on a strong dollar call for a while now. Get a little ahead of ourselves, needless to say. The dollar bottomed in March of 2008. It rallied up on the credit crunch and retraced a bunch of that, on like 80% of that move. And a lot of people thought, well, the dollar was going back into a bear market, but we thought things changed in the world to suggest that the dollar was not going back into a bear market. In fact, the dollar was about to be launched into a major multi-year bull market. And these are really, I guess, have encapsulated the rationales from a global macro standpoint. And again, I want to show you this so it'll make some sense in terms of the rest of our views as it presents some of the worst case scenarios going forward. Let's start with this first one on the left, U.S. capital investment. In here, we have to remember, before we get started here, the U.S. economy really is still the center of global finance. The U.S. consumer really is the center of world global demand. So it does not behoove the world to have a weakening U.S. at all, especially in a world where demand is still questionable, improving slightly, but still questionable. And what's the key really to drive U.S. demand, drive U.S. jobs in the future? And it's U.S. capital investment. We need really money flow into U.S. plant and equipment in a big way to make the U.S. competitive, to create the jobs, to create the consumption, to improve the unemployment situation that's still pressing in the U.S. So that's one. And we saw this happen to a degree during the last dollar bull market. The last dollar bull market was 1992 to 2002. We saw a 10-year bull market in the U.S. dollar index. And the shape of this bull market from a technical standpoint, and even to a degree, although the analogy isn't quite as stark, we saw big capital investment in the U.S. that drove the U.S. dollar when the 92 to 2002 bull market. And it coincided very much with a big bull market in U.S. stocks. We saw money coming in, trying to get involved in the real economy in the U.S. and also involved in the technology sector. And that was a big, big boost for the U.S. dollar. So we had the stock market soaring in the 90s and the dollar soaring at the same time. And this U.S. capital investment was a big driver. We see a similar thing shaping up in here, the potential for a similar thing shaping up in here. And if you look at the money flow of late, the money flow numbers into the U.S., even though there's been concern China pulling back, we're still seeing net positive money flow into the U.S. economy in here. So we think this is started. And if you think about it from what currencies do in terms of their major global macro cycles, when they get down and they look very, very cheap, they overshoot and they undershoot. They overshoot the fundamentals on the upside and the downside, and we think the dollar very much overshot on the downside. The relative fundamental value of U.S. assets was much better than what the dollar would suggest, and this is what currencies do in a broad sense. These multi-year moves, they cleanse the system to a degree. And if you're sitting outside the U.S. and you're sitting on an 80% increase in your currency against the U.S. dollar from the bear market from 2002 down to 2007, 2001 and a half to 2007, 2008, excuse me, March of 2008, the U.S. assets look very, very cheap from that standpoint. So instead of looking at it just from our own standpoint and saying, hey, there's so many warts in the U.S., we don't necessarily want to invest, if you look at it from the outside, and maybe your particular country on the outside isn't looking so great either, U.S. assets are looking cheap, and this is the role that the currency tends to play in these big cycles. So that's number one. Number two, European pressure. And I'll get into more detail on what's going on in Europe in a second. But from a global macro standpoint, the euro when it went to 160 against the U.S. dollar, was probably about a little over 30% overvalued against the U.S. dollar on a fundamental basis. That's a massive overvaluation. Europe has been squeezed on both sides of the fence. If you think of the European exporter, and Germany really is the key here, being squeezed from a very weak U.S. dollar and a very weak Chinese currency on the other side, their other major trade partner, the pressure has been immense on Germany. The fact that they've still been able to drive exports is a function of what global demand was in the world. That too has changed. But the European pressure situation means they would be very, very happy to have the European currency fall in here. It would take a lot of pressure off them. And a falling European currency, i.e. the euro, relative to the U.S. dollar, means it's also falling against the Chinese currency because the Chinese currency is pegged to the dollar. So it helps Germany's relative competitive trade position. Plus, the other countries within Europe, and I'll get into this a bit, are stuck with that straitjacket of the euro. It helps them. So from that standpoint, another second major global macro picture, falling euro, which the flip side is a rising U.S. dollar. The third point is the U.S. real economy. We need real investment in the U.S. real economy in a big way. What we've seen a lot of money being built up still on the balance sheets of financial companies around the world, but it yet still hasn't shown up in loan demand. There's a lot of money out there, and the key is, will it finally get into the real economy, drive small business, because small business is where the jobs come from. And we think at some point it will, and we think the Fed actually moving money, tightening up on the short end of the curve, and this is where it gets a bit esoteric. Please try and stay with me here, and maybe a little bit theoretical. But an actual increase in the Fed short-term interest rates we think would be beneficial from two standpoints. Number one, it shows confidence that the Fed, that the U.S. economy and the money markets are starting to normalize. The process of raising short-term interest rates will tend to normalize the short end of the curve in the money markets. The problem when you have zero interest rates or interest rates that are 0.5%, you basically just destroy the interbank lending market. And the interbank lending market is key to getting money into the real economy. It's key for banks to take liquidity from other banks that have too much of it if they have better loan opportunities than that particular bank. And that's what the interbank market does. With interest rates at 0 or 0.5% or whatever, it tends to denude any lending in that market, and then it tends to be a pipe that closes for funneling money into the real economy. So we think rising interest rates to help money from a technical standpoint, and also rising interest rates in the U.S. relative to Europe for sure, is going to increase the yield differential in the U.S. dollar. Another major driver of our currency is the relative yield differential. And given the pressure that's going on in Europe, we don't expect the European Central Bank to raise anytime soon. In fact, we may even see a cut there. It's very, very possible. The Fed, we have to think the Fed's going to hike, and the expectations are going to increase that the Fed is going to hike more and faster than the European Central Bank. So that's another benefit to the U.S. dollar. So it kind of gets all wound up in this real economy bucket over here.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.